Fellow risk takers, this is your worst podcast host, Andrew Stotz from A Stotz Academy. And today I'm continuing my discussion with Larry Swedroe, who for 3 decades was the head of research at Buckingham Wealth Partners. You can learn more about his story in episode 645. Larry is unique because he understands the academic research world as well as the practical world of investing. Today, we will discuss Chapter 6 from his recent book, Enrich Your Future, The Keys to Successful Investing. And the chapter title is Market Efficiency and the Case of Pete Rose. Larry, take it away.
Thanks, very much. Good to be back. So Pete Rose is considered one of course, the greatest baseball players ever. Has the most hits as a record. And interestingly enough, unfortunately, he has been banned from the Baseball Hall of Fame, although based on his achievements on the field, he would be a first-time ballot, without question, Hall of Famer. He was banned because he violated the rule that you're not allowed to bet on baseball games. Okay? So before we talk about whether Pete Rose won or lost, because he would have been banned regardless of the outcome of his betting, right? And he was a manager of a team when he was making the bets. So he certainly had the ability to influence the games. And although he didn't always bet on games that his team was involved in, he did sometimes. And he bet on other games and clearly played for like 24 years, managed for 6 before he got banned. This is a guy with a lot of knowledge, and we would add, at least in regard to his own team, certainly inside knowledge. He could decide not to play his best player that day and bet against his team, as one example, right? Before we go into that, I want to just talk briefly, review to set the stage, the efficient markets idea, which is what we've been talking about, which leads you to the conclusion that you shouldn't try to pick stocks or time the market. Or at least, if you're going to do it, keep it to an entertainment account rather than taking your IRA to the Merrill Lynch office or the racetrack or the casino. So when I wrote my first book in 98, 20% of active managers were generating statistically significant alpha. It was only 12 years later, with all the advances in the research, that figure was already down to 2% or less.
That's incredible.
So, yeah, and that's even before taxes are considered. And taxes are typically the greatest expense for taxable investors. So it's probably something like 1% of active managers outperforming. And there was no way that anyone identified in advance to know which of investors would be in that 1%. But let's even add one other thing here, Andrew. What if you could identify them in advance? Well, so could a lot of other smart people. And what would happen to their assets under management?
It would balloon.
They would balloon, right? And now their market impact costs would go way up, or they'd have to diversify to own more stocks, not just their best picks. And then their costs would swamp their ability to add value. So as we've talked about before, successful active management sows the seed of its own destruction. So even if you can identify them in advance, that knowledge is probably not likely to help you for very long. Okay, why did we go from that 20% down to like 2% or so? Well, one is that academics were busy converting what was once alpha into what we call beta or different betas. So for example, prior till the 90s, you could buy cheap stocks that sold at low PEs, low prices to cash flow, low prices to book. And because the only factor model we had was from the 60s was the CAPM, or a single factor market beta model. So you generated alpha by having exposure to value stocks. And similarly, you could generate alpha by owning smaller stocks. But once the research was published, summarized by Fama and French in their famous 92 paper, you can't claim alpha anymore because we can measure you against a index, if you will, of value in small stocks that had the same exposure. And then momentum was added and profitability and quality, so that today every investor, as we've talked about, can buy the same types of stocks that Warren Buffett became famous for investing, which were cheap, quality, profitable stocks. And you could do it for 15, 20, 30 basis points and avoid a lot of the expenses and the high turnover that kills active managers. So that's number one. You can't claim alpha if you can replicate it systematically. Second thing, the pool of victims. You need victims that you can exploit. If you're going to outperform, somebody must underperform. And we know on average, it's naive retail investors. They tend to buy stocks that go on to underperform after they buy them, and they tend to sell stocks that go on to outperform after they sell them. So you need victims. Well, coming out of World War II, 90% of all stocks were owned by individuals in brokerage accounts. Warren Buffett had a lot of naive victims he could exploit. Today, something like 10% of trading is done by individuals, just not a lot of victims to exploit. When Warren Buffett is trading, the odds are 9-1, if you will, that he's trading against Goldman Sachs or Renaissance Technology or some other big sophisticated investor. And he doesn't really have an advantage over those. The money chasing alpha. So maybe we've talked about that there are some inefficiencies. Markets are not perfectly efficient, but 25 years ago, there was 300 million in hedge funds, and they were able to make hay generating significant alphas. Today, there's 6 trillion, and the sources of alpha are shrinking. Spread 6 trillion over a much smaller pool, and they can't overcome their 2 and 20 kind of expenses. And while the cost of trading has fallen, that makes it easier for the arbitrageurs to move prices back to the correct levels. Okay, so that reduces what are called these limits to arbitrage. So that's another thing. And then what I think people don't really understand is this, that the skills of the active managers are dramatically increasing. 30 years ago, the typical investment manager was maybe an English major who then went to a training program at Goldman Sachs, got trained. But today, everyone who manages money pretty much is a world-class, either PhD in finance from a world-class university, or a PhD in nuclear physics or math, is a quant working for Renaissance Technology, or many other of these firms like Citadel. So who leaves the field? The people without the skills. And all you're left with are the people who have the most skills. And therefore, the level of competition is getting harder and harder as the weaker players who underperform and then fail, drop out. And 7% of all the mutual funds disappear every year. It's not the ones that are winners. It's either the ones who just were unlucky or were not as skilled. So the competition's getting tougher. So that brings us to the case of Pete Rose. If the markets are efficient in betting on sports, okay, so let's say Pete Rose's team was playing another team and they were the better team, you might have to bet, $15 to win 10. Okay, all right. And those odds, and on the other hand, you could only bet 10, and if you won, you might win 13. And that spread in between those two was the vigorish that the bookies take. So there are costs there, just like there are commissions and bid-offer spreads. In the bookie world, it's typically at least 5%. So you have to be at least something like 3% or so smarter than the mark. You have to win like 52.5%, 53% of the time to overcome that vigorish. And yet, do you know anyone who's gotten rich betting on sports?
Nope.
I don't know. It doesn't mean there aren't people, but we don't know many of them, right?
And if any
And
listeners
that's
or viewers know someone, send them in. Let's identify that.
yeah. And we know we talked about this, I think, on one of our prior episodes in a study done on something like 10,000 NBA games over 6 seasons. The point spread that they estimated the winning team would beat the spread by. So let's say your team is favored by 3 points and they win by six. So that's an error of +3. If they lose by one, that's an error of -2. When they add up the average, all the games the average error is shockingly small. It's less than 1/4 of 1 point. That shows you how efficient the market is. So here we have Pete Rose, who's betting on his own team sometimes, okay, betting on other games with inside knowledge. He's certainly a highly knowledgeable player. And yet he lost a total of $25,000 betting on transactions. Now, he bet something like 450,000. So it's roughly 6%, 5 or 6. That's the vigorish.
That's
It's
huge.
telling you, even with his inside knowledge, he couldn't outperform the collective wisdom of the crowds. And in sports betting, these are people who are betting on their hometown team, or their favorite player or something like that. It shows you how efficient the market is. Here's somebody with inside information. Now, it was illegal for him to make a bet. And just like the case of Martha Stewart, she found out that you can go to jail. Pete Rose didn't go to jail, but he was banned from
Was
baseball.
it illegal or it was a violation of a regulation of
It
the?
was a violation of the regulation. It's not illegal to bet on sports, and there's nothing that prevents you from betting using inside information. So the example I would give you is this. Let's say, are you a tennis fan?
I don't know much about it.
Okay. Well, you may know that Novak Djokovic is one of the great players, maybe the greatest ever. And let's say he's playing in the first round of a tournament, and his trainer who invites you in to sit down and chat with Novak before the match. And, it's told it's time to get out on the court, and Djokovic is, let's say, a 10-1 favorite to win his match. Okay. And he shakes your hand and says, "Thanks, nice meeting you, Andrew." And when he gets up, he trips and twists his ankle. He can hardly move. Andrew, being the smart guy, immediately picks up his phone, calls his bookie, and bets on the other guy. Right? Now, maybe Djokovic might win, but now it's going to be pretty hard. There's nothing illegal to do about doing that. Now, the
And
bookie might
once he
put a
limps out
contract,
onto the court, then it becomes public information. So I've
and then
taken
it's
advantage of
public
it.
and the odds would shift.
Yep.
But now, what Andrew's risk would be is the bookie might take out a contract on you for exploiting that inside information.
So there
If you
are kind of rules against inside information if you start
right.
taking advantage of the bookies. Okay,
Right.
I
So
got that.
the key is here. Think about what are the odds that you can outperform these brilliant PhD mathematicians with all their database. They're spending 100% of their time researching, have access to all the information that you're never going to have access to, meetings, due diligence sessions that you're not going to get. What are the odds that you could do it or identify somebody when all the evidence says not? And here's Pete Rose with inside information, and he couldn't even win.
So there's a lot of different things I wanted to ask about, but the first one I just wanted to ask about because you started talking about this. You referenced The Wisdom of Crowds, the book by
James
Surowiecki.
Surowiecki.
So my question is, you mentioned that as long as people are acting independently, not in herds, they exhibit what might be called collective wisdom. Can you just describe that?
Yeah. So people, let's say you got 100 people and they don't know each other. They live in 100 different cities and they're thinking about, NVIDIA stock. Okay. Some might think it's overvalued, some undervalued. Their actions together determine the price of that stock. Now put those 100 people on a social media site and they're communicating with each other where they could be influenced. Ooh, this guy's smart. I'm going to need to follow him. And everyone jumps on the bandwagon and they think that's a good idea. Now they're acting like a herd. They're not using their independent thinking, doing independent research. And that's how bubbles happen in all kinds of markets, whether it's stocks or tulip bulbs.
What was interesting about this is it made me think it's very rare that you got all these people working independently without seeing the outcome. I guess it happens maybe when the market's down or something like that, but when it's bubble time or moving into that, that's what I didn't understand, the practicality of that statement.
Yeah, so what this is a debate sort of with Gene Fama. I mean, he says, he can't identify a bubble. I think you can. I think we talked about this in one episode when tip yields are higher than the earnings yield on stocks. Tips are clearly safer than equities by a long shot. And so therefore that to me is the sign we're in a bubble. Okay. So when prices are at extreme, and it's created by that, call it FOMO, or the fear of missing out, right? And so everyone piles in. You can it's not a wisdom of crowds anymore because there are risks of shorting, which have been exaggerated or exacerbated, is the more correct word here, by now the fact that we have social media where they legally could gang up on shorts. They can identify that you're short. They can come in and actually use leverage by buying calls. And that forces the people who sell them the calls to hedge. And they have to then buy the stock using what's called complex math, called gamma strategies. And so they buy a certain amount of the stock and the stock goes up. And that now they're more exposed, so they have to buy more, and you get this boom. And that's Melvin Capital lost $4 billion shorting GameStop, a stock which eventually collapsed, but he was dead. So when you have unlimited potential losses and the risks now of shorting and the high cost often of shorting, stocks that are way overpriced tend to be very expensive to borrow. So they'd have to really fall before you can even break even. That has prevented and made it more difficult now from arbitrageurs to correct mispricing by crowds who are being, irrationally exuberant. So I think that one of the outcomes is we're going to see a lot more bubbles, a lot more volatility, a lot more overpricing in thinly traded stocks. Probably not going to see it in the big cap stocks as much because it's much harder to organize. Putting $5 billion into Nvidia stock is not going to move it as much because the market cap is $3 trillion. Putting $5 billion into a stock that's got a market cap of $1 billion, that can make a big difference.
So I want to clarify because there goes from a point where individuals are working on their own, coming up with independent conclusions, and then you could say the hundreds or thousands of people that are doing that, there's wisdom there. But once they all start seeing each other and all that, all of a sudden, I would say it starts to become a bandwagon effect.
Seeing it doesn't mean it's going to happen, that they'll be influenced, right? Right. So I'm aware of what's on social media and stuff, but I ignore it because I don't think there's any value in there. Right.
But what I'm trying to figure out is when the market starts really rising on a particular stock or the overall market, and is there a time there may be a time where there is wisdom there? Let's say
that's Fama's argument. You don't know it's a bubble until it bursts. Right? Maybe there is information. And that's why I'm a big believer. You really shouldn't try to time the market, but if you're going to do so, do it only when valuations are at extreme levels, meaning like it's a 5 standard deviation event, or PEs are 4 or 5 standard deviations above their historical average, right? So historical average PE today, last 25 years, maybe is 20. If it gets to 25, it's high, but at 50, now I'm saying, especially if TIPS yields were 2%, I'd say that's a sign that we have irrational thinking.
So it sounds like, if I was thinking about it, what you're saying versus what he's saying, what you're saying is, in my case, let's say I'm 58, I've blown up 58 birthday bubbles, or sorry, birthday balloons. And I know when the balloon is getting to the limit of popping just through experience. Can I predict, one of them may go a lot bigger, one may go smaller?
Here's the way to think about it. I'll use my own case. So in 1998, it's 1996, I think it was December 96, Alan Greenspan, the chairman of the Fed at the time, coined the phrase. He said, the markets were irrationally exuberant. Now, the PE might have been like 28 or something like that. I didn't do anything at that point. About 18 months later, in the middle of 98, the PE had gotten, I don't know, into the 30s or 40, maybe even, whatever. And I said, look, this could go higher. Bubbles, and the NASDAQ actually went to a PE of over 100, right? So bubbles can get bigger and more irrational, but eventually things burst when earnings can't justify that, okay? So I went from being a more diversified portfolio. At the time, it was about 2/3 value, 1/3 more market-like securities. And I said, the value stocks, which were trading at about 12 PE, about their historical average, but the growth stocks had gone from, say, 18 to 40. I said, right, but the next year, the growth stocks far outperformed again in the first few months of 2000. But then it all burst, and the next 8 years was the biggest value premium ever. Now, I had the discipline and the belief. The discipline was helped by my belief in the strategy. So I stayed the course, and I was able to reap the largest value premium in history. But a lot of people I know who bought value stocks in 96, 7, and 8, abandoned it because it kept getting worse. And they said this time is different, or they couldn't stand the pain. That's why you have to have a very strong belief system, and why I think 99% of people shouldn't engage in it, but 2, if you're going to do it, only do it at really extreme levels.
Yeah, and you missed one other thing that you had, which was knowledge. So I wrote down knowledge, belief, discipline.
Yeah.
And I have a few other things. So one of the things, I just want to summarize what you were saying before about factors. Basically, what you're saying is, before Fama and French identified the factors, we maybe had a feeling, we had an idea, but we didn't have an academic paper that said, these are the factors. So step one, once we identified the factors, or Fama and French identified the factors, and we all knew that those factors could be at play in portfolios, and we could measure whether they were. But we still didn't have a full opportunity to replicate those factors until the funds and ETFs came out. Now, we could have done it by trying to build something around stocks and stuff, but basically then the funds and ETF came out that then provided us the opportunity to get exposure to those factors. And once that happened, it's like all hell broke loose.
So Dimensional Fund Advisors created the first scientific or evidence-based small cap fund, I think in 82 or 83. And they had a micro cap fund and a small cap fund. Then in 92, I think, or 93, when Fama published and French published their famous paper, they added value as a strategy. Then in, I think, 03, they began to incorporate momentum. In 2013, they began to incorporate profitability. And now you can invest in hundreds of different factor-based ETFs, each with their own construction rules and each with their own unique amount of exposure to the various factors.
And in the back of your book, you provide a lot of different examples of funds and ETFs that give that type of exposure.
Yeah.
So I want to ask another question. We talked about the asset size factor, that the bigger you get, the more market impact you have. But I want to ask a question in defense of fund managers or hedge funds, like, trying to argue the devil's advocate. Is there a sweet spot? Let's say you raise $100 million and you say, I'm not taking in any more money. And as soon as I get up to 5 million from my brilliant investment strategies to 500 million, I'm going to pay out 400 million and I'm going to go back to 100 million. Or is there anything smart to do like that? The reason why I ask is because episode 687 was a guy named Richard Lawrence, who has been very successful in Hong Kong, investing in China and the like. And he had a policy of returning funds and then not allowing incoming money at certain times and not allowing redemptions at certain times, which I think was a pretty smart model and probably helped him to have he had about 12% average annual return after fees over a lifetime of his investing.
Yeah. So one, there's a problem is you can't win when you're small because you don't have enough assets to spread the cost of running the fund over. So you have to get big, right? You have to get bigger. Then once you get big, it's hard to turn off. Most managers are not going to do what that guy did because they want the assets, right? And that's how they make money. So it's hard. Most firms will not do it. Dimensional fund advisors, to me, is a perfect example. They used to run funds that were deeper in value exposure and smaller in market cap than they are today. You can't do it when you're running 700 billion, what you could do when you were running 20 billion. They decided they could get bigger and stuff. Now, the funds are still extremely well run. They're great funds, and their fees have come down, which, the scale allows them to lower the fees. But that's offset by the fact, and by the way, they now own many more stocks, so it's more diversified. But of course, they don't own the stocks or only the stocks with the deepest exposure anymore. So, and Vanguard's fund is just much bigger, and they have small value stocks, but their average market cap is over 6 billion. That's not a small cap stock in anybody's definition except Vanguard's. No academic would say that's really a small cap. So that's the problem where we discussed earlier, that successful active management sows the seeds of their own destruction. Now, in the hedge fund world, the key there is you're having to always try to find a new anomaly. Let's say Danish mortgages are trading at some crazy spread for some reason, legislate. So you go in and you raise 500 million, you exploit that trade, and then everyone sees that and they copy it, or somebody publishes a paper, and then the spread goes away. So you have to give the money back and find another one, right? That's the problem. As soon as something gets either found, everyone sees it and they go to try to reverse engineer it, and they get copied because one of the teams says, hey, I want to start my own fund. And then he takes that brain power. That's why it's so hard for people. Even Renaissance Technology, generally considered the greatest hedge fund maybe in history, the returns were ridiculous. When they started to take a lot of assets, it was originally just family money, his own money and the team's money. Then they started taking a lot more money, and those funds did not do well. And they turned it back, and now they basically, my memory serves, are just managing their own internal money because you can't do it in scale.
Yeah. And the economies of scale concept that you talked about Dimensional and Vanguard is really an interesting dilemma for emerging markets like Thailand, because I had a meeting with the SEC a while ago here, and I was, they asked me some questions about, long-term investing and passive investing and that type of stuff. But the problem that they have is if they allow Vanguard and Dimensional to come here and market their funds, it'll wipe out the whole industry here. Now,
but that's a good thing for investors because they'll have access to much lower cost funds.
Well, there's risks there too, right? You don't build any strength in your individual, in your industry. If, for instance, as we see with the U.S. government going against some different countries at times, if you don't behave, it could cut that off or whatever. But the problem that you face is that as emerging market country, you're never going to get the economies of scale. So that economies of scale in the U.S. in particular is just, it's something to be reckoned with, that nobody else can.
Yeah, that was a Vanguard has extremely successful in doing it. I don't buy this idea they're a not-for-profit. They obviously they pay themselves big salaries, which if they were a true not-for-profit, the head of Vanguard would not be making as much money. But they use their scale, their fees pretty much every year keep coming down to getting close to zero in some cases. So that's and they're passing, and then others have to compete. I remember when I first started investing with Dimensional, their small cap fund was like 50 or 60 basis points, and emerging market was 87. Now they're a fraction of those numbers.
So the last question I have is related to this concept of retail investors. You mentioned about the statistic of 90% in the past were retail investors. I have two questions and points of discussion related to this. The first one is, who was taking the profits of these 90% retail investors in the past? And the second thing is, have retail investors are still invested. They've backed up to the fund or ETF level. And now they're bringing their mistakes to the fund and ETF level, where we can see the damage of market timing in and out of funds is enormous from the research that we've seen. But I'm just curious if you could comment about the role of the retail investor.
Yeah, well, the evidence is very clear here. On average, of course, retail investors, the stocks they buy go on to underperform after they buy them, and the stocks they sell go on to outperform after they sell. So somebody's on the other side of the trade. Those are institutional investors. On average, are ahead. The problem is there's now not enough retail investors to exploit. So when you add in the cost of exploiting them, doing the research, paying the managers, the trades and stuff, the cost of running a fund and having an 800 number and all that stuff, right? That's why the vast majority of them lose. It's not because they're dumb. They're really smart and talented and have access to the best databases and everything. It's just the market's too efficient, the competition's too tough, and they have costs. So retail investors should basically, unless they have inside information, true inside information, and if it was legal to exploit it, okay. But we know that it's illegal to exploit true inside information.
I want to thank you, Larry. That was a great discussion to help us create, grow, and protect our wealth. I'm actually looking forward to the next chapter because I have a big blue book on my shelf. In 1993, I bought it when I became a security analyst. And the book's title was Security Analysis. And it was really the only book that I could find to give me some understanding of how I would pick stocks for my clients. Here I was in little old Bangkok with clients at Fidelity in the US and in UK and all around the world. And I had a wonderful career as a security analyst. But here, the title is The Value of Security Analysis. And I'm a little afraid what that value is going to be, Larry. I'm a little nervous there, but for listeners out there who want to keep up with all that Larry is doing, find him on Twitter at Larry Swedroe and also at LinkedIn. This is your worst podcast host, Andrew Stotz, saying, I'll see you on the upside.